Steve Liesman with the Fed making that emergency rate cut move yesterday, as well as some other measures. Steve.
Yeah, Mike, thanks very much. So the day after that absolutely historic moves by the Fed, where essentially what they did is they took a bunch of stuff they did during the financial crisis era over a series of weeks and months, did it all really in one night. Maybe more yet to come. People I'm talking to in the markets right now are really waiting and watching for the impact of what they did last night to show up. It certainly hasn't shown up in the stock market. Although one person said to me, can you imagine where the market would be right now if the Fed had not done what it did last night? But they are still waiting for some improvement in some of the spread, some of the relative value of cash to futures market in the Treasury, some of the more esoteric derivative numbers that have blown out. But what they really want is they want the Fed to come into the commercial paper market. And there's a lot of concern about what's happening there and companies' abilities to finance themselves. That's something that they're going to have to do ostensibly with the Treasury. A lot of talk about that. Let me go over quickly what the Fed did in case you're just catching up here. It cut rates to zero, full percentage point cut. $700 billion of asset purchases. And indeed, they're waiting for that to happen today. $40 billion will be spread out over the day. We'll have to see as these operations occur if there's any improvement in markets. They slash reserve requirements to zero for thousands of banks, and they ease the terms and the rates at the discount window and on these dollar swap lines. Guys, we were in the field with a survey, a Fed survey, before the Fed took these actions, and I want to show you where they put the recession probability, which is now 67% according to our Fed survey. It's the highest we've ever had in the 10 years we've been doing this, and that's up from 41%. That's the probability of a recession in the next 12 months. Now let me show you, because we asked for the first time here, the growth trajectory expected by our 40 respondents. And this is very telling because it's very similar to what Fed Chair Jay Powell talked about last night. A modest first quarter growth, an actual decline in growth in the second quarter, about flat next quarter, and then the rebound happens in the fourth quarter. This is 6 months later than anybody was ever talking about. I want to say as recently as 2 weeks ago or a week ago, but now the outlook is for an outright decline in the second quarter. And essentially what Fed Chair Jay Powell said last night is the third quarter is up in the air relative to the spread of the virus and the amount of economic activity that has to be reduced in order to keep it from spreading. Carl?
Steve, I mean, 67%. Do you wonder what the other 33 are thinking?
I think they're thinking we can just barely avoid it. Look, a recession is not really 2 negative quarters of growth. A recession is when the National Bureau of Economic Research meets and determines that you've had a prolonged, protracted, and pervasive decline in economic activity through a whole bunch of different metrics. So it's possible to technically avoid. I've heard analogies this morning, Carl, to the 1980 recession, a short, sharp drop followed by a quick rebound. It was long enough to count as a recession, but it was short, although severe. That's one analogy I read this morning. It's possible that some people think that the combination of Fed policy and fiscal policy can help us avoid an actual recession. But as you see from that graphic, there's a large percentage of people who don't think that's possible at this point.